I'm Kay Stice. I've been a business school professor for 35 years and have taught at business schools all around the world. You can learn more about me and about my brother Jim at our website, sticelearning.com. If you learned something interesting in this current event video, please remember to like it and subscribe to our channel. On January 14th, 2021, the Wall Street Journal ran an article describing a huge increase in the share price of Gamestop, an old-fashioned brick-and-mortar video game store. GameStop had been hammered by competition from digital and online competitors, and hundreds of GameStop stores had been closed. At the lowest point in March 2020, GameStop shares were selling for $2.57. And then GameStop shares took off. Things really started to get crazy on Monday, January 25th, 2021, when GameStop shares reached an intraday high of $159.18. And that wasn't the end of it. During the day on January 28th, GameStop's share price reached $483. So what happened? Well, an online insurgency led by small retail traders on Reddit, an online discussion board, organized an effort to buy GameStop shares. Now, why GameStop? Well, two reasons. First, some investors were convinced that GameStop shares were undervalued because the market was overlooking the option that GameStop had to pivot from a brick-and-mortar emphasis to digital sales, online games, and mobile applications. Okay, well, that sounds reasonable. These investors argued that GameStop shares were being valued based on GameStop continuing its old-fashioned business model. Great value can be unleashed, they say, if GameStop leverages its brand name and customer relationships and moves into the online space. Okay, so far so good. But this would involve a slow, steady share price increase as the overall market comes to recognize GameStop's potential. Why the skyrocketing share price? Well, that brings us to the second reason, a short squeeze. Let's start by talking about what it means to sell short. I'll describe what you or I would have to do to sell some shares short. Let's say that we believe that the shares of Tesla are grossly overvalued. To act on this belief, we contact our broker, arrange to borrow some Tesla shares from someone who owns them, sell those shares now, and promise to replace those shares at some set date in the future. Of course, there are going to be some trading fees, but let's ignore those. In simple accounting terms, I have the cash from selling the shares at today's trading price, and I have an offsetting obligation to replace the shares at a day in the future. Well, let's put some numbers in this example. We'll say that Tesla's price per share today is $700. So we get $700 for short selling one share. Let's also say that we guess right, and Tesla's share price drops to $580. When we close our position, we use $580 to buy a Tesla share in the open market, return the share to the person from whom we borrowed it, and we come away with a profit of $120 on our short sale speculation. $700 we initially received minus $580 we have to pay to replace the share. Yeah, but what if Tesla shares go up to say $880? Well, then we guessed wrong. When we close our position by buying back a Tesla share in the open market, we suffer a loss of $180 on our short sale speculation. $700 we initially received minus $880 we have to pay to replace the share. Okay, so where does the short squeeze come in? Well, in late 2020, GameStop shares had increased to $20 per share. A number of big money investment funds were convinced that GameStop's share price would go back down, maybe even down even further than the $2.57 per share back in March 2020. So these investment funds bet against GameStop by selling the company's shares short. Actually, many of these funds purchased put options on GameStop shares. The economic effect is the same as a short sale. Maybe we can talk about put and call options some other time. Well, when you borrow shares to sell them short, you eventually have to replace them. In other words, you're on the hook to be a buyer of those shares in the future. The online trading community realized that there were so many GameStop shares sold short that the investment funds were going to have a hard time buying up enough shares to close their short positions. So the small retail traders and other investors kept buying and buying, knowing that eventually the big investment funds would have to come crawling to them to get the shares to close their short positions. This orchestrated buying turbocharged the demand for GameStop shares. Small retail traders and other investors gleefully buying the shares, and big investment funds desperately trying to buy shares to close out their short positions. This double demand, plus the increasing desperation of the short position investment funds as they saw GameStop shares becoming more expensive by the minute, created a market frenzy, a short squeeze. And some of the small retail traders took perverse pleasure in punishing the big boys. The Wall Street Journal reported that one big fund, Melvin Capital, lost 53% of its fund value in January 2021. 53%. In response to this news, one small investor posted this notice online, only 47% left to go. So, a short squeeze can happen when some investors have sold so many shares short that other investors can make it difficult for them to buy the shares they need to close their short positions. I hope you enjoyed this current event. Please remember to like this video, share it with a friend who needs to understand what you and I now know, and subscribe to the channel. Thanks.